everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, and I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is family trust. A few of my clients, actually more and more clients, come up to me and ask me, hey Cherry, should I set up a family trust to hold my real estate investment? Well, the reality is that family trust has a lot of tax advantage and a lot of disadvantage as well. It's not necessarily tax related. So today we're going to talk about the pros and cons of family trust and how it can be applied and used in combination with death and taxes in Canada that we mentioned in our previous episode to help you lower the amounts of taxes. And we'll go through a particular example in terms of how we could potentially apply family trust in your tax planning, structuring to minimize the amounts of taxes that you would otherwise have to pay if you are a real estate investor. But before I get started, make sure you give us a thumbs up if you like our video and hit the subscribe button below if you want to stay on top of the latest tax tips. Now with that, let's get started. Now, family trust is essentially just a trust, an entity, and it has its own filing obligation. It is a trust, and the boss of this trust, this entity, is called the trustee. So the trustee has all the say of how to control the asset that's owned by the family trust. But the trustee doesn't really own the trust. The trustee is really just a trustee managing the assets underneath and managing the distribution of the family trust, the income earned by the family trust. The family trust also has its own filing obligation as well. It could be set up and then you have to file the family trust return on a regular basis, assuming that it is earning an income. If it is not earning income, then you may not have to file taxes, depending on the nature of trust. There is filing obligation, there is setup fees associated with it. These are potentially the disadvantage of having a family trust. The cost to set up could be anywhere from $2,000 Canadian dollars all the way to tens of thousands of dollars, depending on the complication that's involved, the amount of properties that's involved, what you're doing with it. The setup itself may not cause a lot of legal fees, but whatever that's behind, the brain that you have to pay for, the professionals that you have to pay for implementing a plan could be substantial. Now, the other downside of using a family trust is the cost of filing. As I mentioned, it is its own entity, so the trustee has the responsibility to file a tax return on an annual basis. It's the T3 trust return that you would have to file, assuming that the family trust is earning an income. Now, another thing that people don't often talk about is the 21-year rule about family trust. Essentially, when you set up a family trust, the family trust being set up has a 21-year lifespan on its own, unlike a corporation that could live forever, even beyond the shareholder's lifetime. The corporation can continue on, and it could exist for hundreds of years. Family trust does not have that. Family trust can only exist for 21 years. It doesn't stop it to exist beyond 21 years. What that 21-year rule implies is that the assets owned by the family trust has to be distributed to the beneficiary of the family trust upon the 21st anniversary of the trust. If it isn't distributed, then the family trust would be deemed to dispose the underneath assets at fair market value, which is also not beneficial. Generally speaking, the whole point of setting up family trust is to be able to transfer the asset that you currently own to your next generation on a tax-free rollover basis. So if you don't distribute the asset within the family trust on or before the 21st anniversary, the family trust would be deemed to dispose these assets at fair market value and being taxed at the highest marginal tax rate in Canada, personal tax rate, not corporation tax rate. So it kind of sucks if you don't distribute the assets underneath. There are strategies to bypass that 21-year rule, but it gets a little bit more complicated, and sometimes it defeats the original purpose of why you set up the family trust to begin with. The last downside of family trust is that sometimes you don't know what you don't know. And sometimes when you set up a family trust thinking that, hey, I'm passing on the asset to my kids, but your kids may not want it. Your kids don't even like it, and you may end up selling all the assets before they get to the kids. And it kind of defeats the purpose of carrying on all these additional filing obligations, the setup costs and everything, when your kids don't even want what you want to give them via the family trust. So there is no opportunity unless you have that conversation with your kids and your kids are really committed to it, then that may be a way to defer some of the taxes that you have. Now that we cover all the cons of family trust, I should say that now we can talk about the pros of family trust. Now, what are the benefits of setting up a family trust? Now, the family trust, essentially, when you set it up, there are quite a few advantages of it. As a matter of fact, Erwin and I just set up our own family trust as well, owning shares of a corporation that we just purchased. And the reason why we have a family trust set up is because the business that we are in, they are small business and they are qualified small business shares. And what it really means is that upon sale of these, the shares of the corporation, assuming I would be able to continue to run the business and one day, sometime down the road, I would be able to sell the shares of these this particular business corporation, and assuming that it still meet the criteria, I would be able to sell the shares on a tax-free basis for up to $900,000. Every single one of us in Canada has something called lifetime capital gain exemption. A lot of real estate investors misunderstood it and think that they would also be eligible to sell the shares of their corporation and use that lifetime capital gain exemption. But the reality is that this lifetime capital gain exemption, $900,000 in total as of today, roughly, it's being adjusted every single year, but as of today is roughly about $900,000. You're only able to utilize this $900,000 lifetime capital gain exemption on qualified small business corporation shares. So qualified small business corporation shares means that you, generally speaking, you run an active business. And there are some criteria that you need to meet, the business has to meet, but generally speaking, it's for businesses that are active and you're able to find a buyer to sell it. So with the family trust set up to own the shares, potentially I can multiply that lifetime capital gain exemption on the sale of the shares, and thus help me to lower a lot of taxes if I were able to sell the shares of the corporation that I own sometime down the road in the future. I would be able to split income, essentially split the capital gain with my husband or my kids as well, assuming that they are over the age of 18. So that provides a lot of flexibility when I have the shares being owned by the family trust. Now, family trusts also provide a lot of control. Now, what I mean is that when you are not sure who's going to get your assets, you want the flexibility or you want the control to know that, hey, my kid is getting older. My kid is let's say my kid is in his 30. My son is 30 years old and he's now dating a girl. But I don't really know if this girl is really the right person, and I don't want that girl to take half of his assets if they don't get along well and divorce down the road. So I want the security to know that, hey, I can keep the asset. I have control over the asset. I don't have to distribute the assets to my son until 20 years from now. So that family trust, essentially, when the family trust owns the assets, your son being the beneficiary of the family trust does not really own the asset. And even though your intention is to provide the asset to your son sometime down the road before the 21-year rule expires, your son doesn't really own it. So your son's significant other may or may not have access to that asset class until one day you decide, hey, your son is a good son in your eyes, and they are in a good relationship, you're comfortable distributing the asset to the son, and that would be one of the reason why a lot of people prefer having a trust instead of giving the shares to the son immediately, right from the get-go. Another benefit of having a family trust is the flexibility offered by the family trust. Now, what I really mean is that when you have a family trust, you have the beneficiaries, you can choose to distribute different type of income to different type of investment income to different type of beneficiaries. And you can also choose to Like if one beneficiaries prefer to have cash, you can share the investment income with that beneficiary. But if the other beneficiary prefer to be more involved in the small business, you can then distribute the shares to that particular beneficiary. So there is a lot of flexibility built in. You have the trustee essentially has the right to distribute the asset or income, so then you would be able to minimize the amount of taxes, and you would be able to make a fair distribution among your family members. Another thing about the family trust is that, using a simple example, you are buying a property at $450,000. It's a rental property. Now you're using a family trust to purchase this rental property. The family trust owns this rental property, reports the rental property income and expenses, $450,000. The family trust owns it. You don't own it personally. You could be the trustee of the family trust, but you don't own it personally. Let's say the property is worth $800,000 tomorrow and you pass away tomorrow. Now, who's going to pay the capital gain tax? Nobody, because you pass away, you actually do not even own that rental property, even though it's worth $800,000 and you purchase it for $450,000, because it's now being owned by an entity called family trust. Now you're no longer the trustee of the family trust. Someone else has to step in to be the family trust. Hopefully your trust document would have something specify who's going to take over that position if you were to pass away. Now, if that's the case, and if on the trust document it says that, hey, if in the event that certain people pass away, this particular property is going to be distributed equally between your daughter and your son, 50-50. So then each of them would own 50% of this particular rental property, and they still don't need to pay tax. There could be land transfer tax implication in Ontario, though. When you're changing hands, distributing the asset, underlying asset to the beneficiary, there could be land transfer tax situation. But from an income tax perspective, even though it was purchased at $450,000, when it's being distributed equally, 50-50, between the son and the daughter, each of them would be assuming the purchase price of $225,000. So combined total of $450,000. Which was the price that you pay years ago when you purchased a rental property in the name of the family trust. Now, still, nobody pays the capital gain tax on the property because the property is still within the family trust and it's still within the beneficiaries, although it could trigger land transfer tax. And this is where the tax deferral opportunities comes in, because the gain could be accrued on the assets that's owned by the family trust. And nobody needs to pay the tax, even if the person who actually contributed the asset was the one that purchased it years and years ago in the name of the family trust. The original person could pass away, and the parents could pass away. The beneficiaries are the kids, and the kids are going to take it over using the same price that the parents initially pay for in the name of the family trust. So this is where the tax deferral opportunities comes in. Now, with that, let's go into details in using the similar example, same example that we had from our previous video on death and taxes, and we're going to analyze how family trust would be useful in the real estate investors world. Okay, let's get back to our old example that we presented earlier on. We have Sharon and Spencer from our previous video. We talked about the old condo that Sharon owned, and we knew that Sharon, in our example, passed away when she was in her 40s, and then everything got inherited essentially by Spencer, the husband. And Sharon also co-owned this home with Spencer. Now, we knew that they were having a lot of problems in terms of the tax problems that Spencer would have to pay if he were to pass away without any tax planning. Now, the problem would be multiplied by many, many folds if they actually have a decent-sized portfolio. We have 1, 2, 3, 4, 5, 6 houses plus their own home. So let's assume that they have like 6 rental properties plus their own home, so 7 properties in total. These properties might have been worth at the age of 40, $7.5 million. But by the time when Spencer get to 90 years old, these properties would be worth $28 million. From $7.5 million to $28 million is quite a jump in 50 years. Now, it's not surprising that it has jumped so much, but let's just go with this. And assuming that all these properties, they purchase it all for $450,000 except their own home, what's going to happen? Well, what's going to happen is that you have a rich people problem. So that is a good problem to have. If you do have to pay tax, consider that lucky because not everybody has to pay tax. So always strive to pay tax, although we try to minimize it as much as possible, but consider yourself as a lucky person if you have to pay tax. Now, what's the tax implication if you have a $22 million net asset at the age of 90? Spencer is now worth $22 million. And the properties that he owned is all about $2.7 million when he bought it all together. So now he has about a $19 million capital gain. Although, based on today's rule, the capital gain is only 50% taxable. So only half of that capital gain would be taxable, subject to tax, which is $9.6 million. Now, assuming that he also take capital cost allowance on these properties that we discussed before, and he would have to include that as income on his terminal tax return, that gives us a taxable income of $11 million. Now, $11 million taxable income is a lot of money. You do have a rich people problem. Spencer does have that problem if he were to die at the age of 90 without tax planning. So the tax payable using today's rate and also tax payable using today's marginal tax bracket, the tax liability would be $5.6 million, a huge, huge problem. Now, alternatively, he can choose not to have this problem. He could do something called an estate freeze. Essentially, he transfer all of his assets to the family trust or transfer it to a corporation that's owned by the family trust. And he then, by doing this transfer, he's fixing the value of the asset at the current transfer date, and he's also fixing the amount of liability that he would be exposed to at the time when he passed away. So when he do a proper estate freeze, he would transfer the properties either directly to the family trust or to real estate holdco. And by doing so, he would then freeze the asset value and freeze the actual capital gain that he would have to pay for. Even if he were to die tomorrow or 10 years from now, he would still pay more or less the same amount of taxes. And he could actually reduce that amount depending on how he's going to handle the transfer. And in turn, the company that's owning the properties would be owned by the family trust. And the family trust could have the beneficiaries of in the names of the children and grandchildren, or any family members that they like, or any arm's length people. There is no particular rule that doesn't allow you to have arm's length people in the family trust as well. So essentially what it does is that all the future growth of the property from, let's say the property is worth $800,000, and the future growth could be $200,000, $300,000. Is that $200,000, $300,000 is being transferred to the family trust, and in turn being distributed, the future growth would be distributed to the beneficiaries of the family trust. It's now no longer belong to the parents. What the parents own is really the value of the shares at the time when the transfer happened. The property is worth $800,000 and they purchase it for $450,000. Technically, the capital gain delta would then belong to the $350,000 capital gain would then belong to the parents' shares. And so by having this arrangement, they know exactly how much taxes that they would have to pay, whether he died today, they die tomorrow, they die 10 years from now, or 20 years from now, they would still be paying taxes on the $350,000. Okay, now as you can see, based on the illustration that we did, the parents could lock in their tax liability on their terminal return by doing an estate freeze. And by having the family trust owning the shares of the corporations that owns the underlying properties, they also retain control of the family trust. They retain control of their properties. They also would be able to distribute the dividends as they choose to the beneficiaries of the family trust. So they have a lot of flexibility. Now, the downside is that if the parents decide to sell everything, all the 9 properties in our example, within the corporation, and decided to wind up the corporation during the lifetime, there is really no reason to set up the family trust to begin with, because the kids are going to get cash at the end. Or let's say the kids have no intention to take over the rental portfolio at all. They're doing things in their own way, living their own lives and doing really well. They don't really need that portfolio of real estate. There is no point setting up the corporation as well. So it really goes back to the particular taxpayer situation before we would advise our clients on whether they should set up a family trust or not. Now, as you can tell, this is not something simple and straightforward. It is important to get a better understanding, sit down with someone that understands your situation to advise you appropriately. So if you have questions and if you want to control or limit the amount of taxes that you would have to pay, consider setting up a family trust and talk to us. I'll talk to a professional advisor that understands your particular situation. Now, if you find our video useful, make sure you give us a thumbs up. If you like to stay on top of the latest tax tips, make sure you hit the subscribe button below. Until next time, happy Canadian real estate investing.